This is level 1 of the CFA program, the topic on derivatives, and the module on forward commitment and contingent claim features and instruments. You might remember that module 1 was pretty much just an introductory reading. In module 2, we're going to go just a little bit deeper, and instead of just talking about general forward commitments and general contingent claims, we're going to go ahead and talk about some specifics inside of each of those. So we're going to define some of these contracts. We're going to go ahead and find out what happens at expiration to determine whether there's a profit or loss. And then notice that third LOS looks an awful lot like one of the LOSs that we had in Module 1. So let's go ahead and get started with a forward contract. This is really just a super contract. Remember, it's a legal and binding contract in which two parties just get together and they look at each other and say, hey, you know what? Let's go ahead and trade. But let's not trade today. Let's agree to trade at some time in the future. Now, remember in that Module 1, we talked about the various underlying assets. So forward contracts are mostly written on currencies and interest rates, but they can be written on almost anything. And the module talks about things like corn and wheat and gold, electricity, natural gas. There's foreign currencies in there. So think about this. For the exam, the Institute could ask you a question on just about any underlying asset, but it'll probably be one of those. Now, one of these interesting features about forward contracts is that when we agreed to trade today, we agree to trade today and we agree on a price, that's not going to be today's price. That's going to be the price at some date in the future. So we call that a forward price. And notice in that blue arrow point, we have the words at a fixed price. So you and I could agree to trade something super simple like a share of stock or an ounce of gold or 100 Canadian dollars per US dollar. And what we would agree on is trade at that fixed price in the future. So regardless of whether spot prices go way up or way down, we've locked into that. So you see the attraction of forward contracts is this is used by businesses all over the world to lock in either a future inflow or a future outflow. So forward contracts are great hedging devices, but they can also be used to speculate. Now, of course, when there are two individuals like you and I, or two organizations like two financial institutions, one party may decide not to participate at the end of the contract. So this is called a default event. And of course, since this is a legal and binding contract, we can bring the court system in to make that determination of who has to pay and when they have to pay. All right, then LOS asks us to take a look at what happens at the maturity date of the forward contract. And so what I want to do is I want to give you just a quick example. You might remember that I mentioned my calculator in that last module. So let's suppose that you and I agree to trade this financial calculator for $100 in 1 month's time. All right, so after 1 month, what happens? I show up with my calculator, you show up with a $100 bill, and we switch, right? Now, one of the things that you'll learn, and I'll emphasize this here in level 1, level 2, and level 3, is that almost all derivative contracts are cash settled. Most people really don't want to, and most businesses don't really want to actually trade the underlying asset. So it's just a settle of cash. It's way easier to settle in cash than to go out and try to find the underlying asset. So I want you to think about this. So let's suppose that I show up with my calculator. You agreed to give me $100 for this calculator, and the spot price is $200. Oh man, so what's happening here? You are so happy because you're going to buy this calculator for just $100, and you're buying something that's worth $200. So look down at the bottom there. At the maturity date of the forward contract, you receive a payoff of the spot price at that time t minus the forward price that we had agreed to at initiation. So in my example, it would be $200 minus $100. Now, of course, payoffs for forward contracts are symmetric. So I pay you that $100 and you receive that $100. So your gain is my loss. And that's what this slide is about, the short payoff here. So look at the, well, here, let's just go down to the bottom. So the payoff is spot minus forward, and that's for your position, right? Because you were buying. And here's the payoff for the short. Now you just put parentheses around that little equation. You put a minus sign in front. So look at the bottom, buyer and seller engage in a zero-sum game, of course ignoring transaction costs, because you may have to pay a transaction cost and I may have to pay one, and they might not be the same one. But in my simple example with the financial calculator, now of course you might need that financial calculator and I might want to get rid of it. So we can always settle with the physical asset, but most derivatives are settled in cash. So here's a good table. My advice is for you to just think about my little calculator example that, you win if the price goes up. But let's suppose the price goes down and it's only $50 as the spot price for my calculator. Well, then what happens? You hand me $100. I hand you my calculator. You're not happy because you're paying $100 for something that's only worth $50. So get out your phone and take a picture of this little table and go ahead and include that graph over there. Notice that we've written down at the bottom that this is a line, so this is known as a linear derivative because every dollar that you go this way in the underlying asset, you have a dollar in profit or loss in the opposite direction. So a linear derivative. All right, let's take a look at a more specific example, very similar to my financial calculator example. But let's suppose that we're a company here, Minners. We enter a forward contract to buy 80 kilos of gold at $53,000 per kilo. Spot price of the gold today is $52,200 per kilo. So I want to make a comment on this before we get into the solution. So note that the spot price today, $52,200, is what we would buy or sell the gold for today. But we enter this forward contract and we don't know the details of the contract just yet because that's not too important for the math. Maybe it matures in 6 months or 12 months, but we're going to agree to pay $53,000 at the end of that time period. So if we wanted to buy the gold today, we'd only have to pay $52,200, but we want to borrow it sometime in the future, so we're going to pay $53,000. I want to comment here that in general, in commodity, forward, and futures markets, the forward and futures price is probably going to be higher than the spot price. And we'll talk about these models, especially in level 2. But I wanted just to give you a heads up, and that's mostly because if you're going to buy the contract, if I sell it, you're gonna pay me to store the gold for that time period. All right, so the 52,200 is not too terribly important for this particular LOS, but I wanted just to give you a sense of what you're going to be faced sometime in the future. So notice after the comma, what we've put is that the spot price of gold at the maturity date of the contract is $52,780. So remember, you agreed to buy, so you were long, so you benefit if prices rise. I agreed to sell on the short position, so I benefit if prices fall. So notice that teardrop question: how much will Minners pay or receive to or from the financial intermediary? So let's go back to that. Let's go back to that equation we had in a slide or two. Our payoff at maturity is going to be the $52,780, which is the spot price at the maturity date. Notice there's a subscript capital T there, minus the forward price that we had agreed to way back at initiation. So that's $220, and that means that you lose. You're Minners, right? I'm the seller of the contract. You were long. You were hoping the price went up to, say, $55,000 US per kilo. And if that would have been the case, then I would have had to have paid you $2,000. Now, the good news as we move through forward contracts to futures contracts is that you already know this stuff, because a futures contract is nothing more than a standardized forward contract. Now, the complication for you guys is that there are some extra elements that we need to worry about because of this standardization process. There are forward contracts on futures exchanges on lots and lots of underlying assets. There's a couple of examples there. Remember what I said back in Module 1, these standardized futures contracts, they trade on a futures exchange. Could be an over-the-counter market, could be an organized exchange. But the exchange itself gets to determine the standardization. For example, if you wanted to buy or sell gallons of gasoline in New York City, when you'd go to the mercantile exchange, you would have to agree to trade 42,000 gallons of gasoline. That's the standardized amount. Not 38,000, not 52,000, but 42,000 gallons of gas. So they determine the underlying size of the asset, they determine the size of the contract, and they determine when those contracts mature. There's an example, that second arrow point. If you want to take the long or short position in an oil futures contract, you have to do it in increments of 1,000 barrels. So if you're an oil well and you're producing, let's say, 2,000 barrels a month, then you would just enter 2 contracts. Now back in this, I'm going to go back here back in this forward contract example, notice that Minners entered the contract with a financial intermediary. So these are two entities, and there's default risk between those two. So if one defaults, then the other one has to sue. If the other one defaults, then well, you get the idea. But notice that last arrow point down there. The futures exchange itself is the counterparty in all future transactions. So remember that illustration we had back in Module 1? Here's Minners and here's the financial institution, and they were getting together in the forward market. That was an over-the-counter market. But now, if we go to an exchange, there's somebody in the middle. There is and it could be my exchange. I mean, it could be Jim's future exchange in the middle. And what will happen is that I will write a separate contract with the short position, and I will write a separate contract with the long position. So that if one of those two entities defaults, then I would sue one of those two people. And you see what that does? It increases liquidity, it increases transparency. So then you and the counterparty, really the ultimate counterparty, don't have to worry about default risk, because here I am, I'm Jim's future exchange, and I'm just assuming I'm Jim, and I'm big and I'm powerful and I have lots of money and I can handle all that risk. All right, so the return profile is exactly the same as it was back for forward contracts. However, remember I said to you that there are some complexifications, not sure if that's a word, with futures contracts. So think about what we're doing. We're trading these on an exchange, which means they probably trade a lot. Well, this is called marking to market, and this is daily settlement. So what happens is that every single day there is a winner and a loser declared, and that winner or a loser that is declared has to either deposit some more cash, I'll call it cash here for just a minute, and the other party can withdraw cash at the end of every day. You might remember in the Module 1, I referred you to the Orange Juice Futures contract and that great movie with Dan Aykroyd and Eddie Murphy. There's your homework assignment, as long as it doesn't interfere with your study, and go watch that movie. All right, so let's go ahead and figure out about marking to market. So here's the cool thing. Let's go back to Eddie Murphy and Dan Aykroyd. What they did is they took the short position in Orange Juice Futures contracts because they had inside information. So they wrote a contract with the exchange, and then the exchange wrote a contract with all of the people who wanted to take the long position, which included the brothers Duke and Duke from Duke Securities. All right, so what happens then is that it doesn't cost either party, Eddie Murphy and Dan Aykroyd or Mortimer and Randolph Duke, they don't have to pay each other today, right? When you and I agreed to trade my financial calculator, there was no cash that changed hands at initiation. We waited until the end. Well, the same thing holds true in the futures market. However, this is a big however. However, remember the middle entity, this clearinghouse, this exchange is assuming the counterparty risk. So to manage that risk, the counterpart, the clearinghouse requires that both parties put up what's known as an initial margin. And the cool thing is that that's each of those entities' money. That's their capital. You're not paying for anything. You're just putting in a deposit. It's like an escrow account. So then what happens when the underlying asset price changes value every day? What the middle entity does is just take from one account and pass it along to the other. Take from one account, pass it along to the other. And this happens every day. And this is called daily settlement. So look at that first embedded bullet point, where profits and losses are charged and credited to the short and long positions each day. And the end of day settlement price. So there's an initial margin to the futures margin account. So there's a timeline there. This is a little bit helpful. So what happens here? We post the initial margin, and then the price changes at the end of that first day. And then we do that every day and every day and every day. So we could put a lot of lines on that timeline there. And then all the way at the end, there's the final settlement. And that final settlement is really just like a final settlement, a final daily settlement. All right, so let's go ahead and make sure you understand some of these definitions before we work through a pretty cool example. All right, so we have this, skip down to the bottom first. We have an initial margin. So both parties are going to post this initial margin. It's probably less than 10% of the futures price, deposited by both parties to cover future possible losses. Okay. So let's just suppose for some reason that margin is $100. And what happens? Then at the end of the first day, if the price changes by $5, well, then the clearinghouse then just takes $5 from one party and hands it over to the other, which means at the end of that first day that one party has $95 and one party has $105. All right, so that's okay. That's the initial margin. Well, there's also something called a maintenance margin, and maybe the maintenance margin in my example might be $80. So what happens is that when that margin goes from 95 maybe to 90 to 80, but once it goes down below 75, then that party has to put the full $100 back in. So that's what a margin call is, and they'll have to deposit additional funds, which gets to the variation margin. And so up at the top, that first arrow point, that's just explaining how the clearinghouse is just going in and out and in and out. Now let's suppose that a counterparty fails to honor a margin call. Then what happens is that account is, you guys know sign language, the exchange or the counterparty or the clearinghouse just says, okay, that's enough. We're closing it out, and may impose additional losses. The exchange probably has some kind of an insurance fund. What they'll do is bring out another financial institution and say, you know what, if we lose some money, will you help us pay? And so of course. So what can happen here if the exchange is losing money? Well, they can increase margins, they can establish price limits, they can establish circuit breakers, which is a big old timeout. Those circuit breakers became super popular. Actually, they were created after the 1987 market crash. I was in graduate school at the time, and my professors, oh my gosh, some of them were mortified that the exchange would come in and stop trading because, wait a minute, efficient markets hypothesis, prices should be transparent, there's value in pricing, and so when you call a timeout during the course of the day, then these people over here and these people over here, they get upset about it. But the circuit breakers have actually worked fairly well, I think. All right, so let's suppose we go back to our Minners example as well as we did before, but let's do this with a futures contract. All right. So we're going to do the same thing. We want to enter a 3-month futures contract. We want to buy 80 kilos of gold. And there's that opening futures price of $53,000. So that's the same thing. But what we need to worry about now is that since we're doing 80 kilos of gold, we need to take that 80 times 53,000. So our total futures position is $4.24 million. Wow. So what we're going to do is we're going to put up an initial margin of $127,200 and a maintenance margin of $115,750. So notice that the maintenance margin is always a little bit less than the initial margin. So let's go through a couple of slides that give us some examples of daily market settlement. We're going to call this marking to market. All right, so there's day T with 90 days to go. There's our futures price. So what do? We're minners, right? Back here, we're minners. And so we need to put in a initial margin of $127,200. Everybody with me? Now, so minners back here, we're taking the long position, right? The long position. So there's a short position out there somewhere, and that short position is going to have to do the same thing. They're going to have to put in $127,200 as their initial margin. So let's go ahead forward through the timeline. Let's go down that left-hand column, T with 89 days until the contract matures. Let's suppose the futures price goes up to 53,124. Well, let's take the 53,124, multiply that by 80, and then subtract it from our 4.24 million that we have there in the middle, and we have daily gain of $9,920. Wow. So we took the long position. We benefited if prices rose. So they went from 53 up to 53,124. So this is great stuff, right? How easy is this, right? You bet that the price goes up, and then the price goes up. Boom, you win $9,920. So look in that not the far right column, but the second far right column, notice our margin balance is 137,120. Now we can choose to keep that in there. Now this is not part of the LOS, but in reality, we can choose to just keep that in there, or we can withdraw it. We can withdraw $9,920, and we can go out and spend $9,920 on whatever it is that we want to during the course of that day. Or we can tell the exchange, hey, take that $99.20 and go buy a treasury bill or something, so we at least get some interest, and maybe the exchange will pay us a little bit of interest on top of that. Or maybe not, so there are all different sorts of ways to handle that margin balance, but forget about that for now for the LOS. All right, so what happens on day T88? 88 days left. So the price was 53,124 yesterday, right? T89. Today, T88, it's 53,080. Oh, wait a minute. This is not good news. Now, the price hasn't fallen all the way to 53,000, only to 53,080, which means we lost some of the money that we won yesterday. So if you take the 53,080, multiply it by the 80, and then subtract it from the previous day's total, you get 3520. So what happens? We lost, what is that? About a third of what we gained the first day, which if you look in the middle column, which means we have about 2/3 left of our total gain and loss. So our margin balance is now 133,600. And then what happens on day T87? I think we have another slide here. So let's go to this day T87. Oh my gosh, the price falls precipitously. So now we need to take the 52,600 times the 80 and subtract that from the previous day's total. Don't go back and subtract it. Here, let me do this. Don't go back and subtract it from the 4,240,000. This is a rolling daily settlement. We already settled on that initial day, so we settle from that previous day. So we lost 38,400. So that's 32,000. So look at our margin balance. It's only 95,200. Well, that falls below our margin. Let me go back here. What was our maintenance margin? 115,750. So we need to go ahead and deposit $32,000, which gets us back up to the 127,200. You see how that works? The variation margin gets us back up to the initial margin. And then the next day, on day T with 86 days remaining, we win some more money, and now we have a margin balance of 161. And we're going to do that every single day, every day, until we get to day T, which would be the very last day of the contract. And so in order to determine the total position, you need to sum that middle column of net gains and losses. So imagine this in an Excel spreadsheet, just sum that total, and and you'll get the total gain and loss for that 90-day period. Now, let me just warn you here. Go down to that T, capital T in the bottom left. If that said $53,000, if the price on the maturity date of the contract was $53,000, and that was the initial price, then our total net gain or loss would be $0. If it's higher than that, then we win because we had the long position. If it's lower than that, then we lose because we had because then the short position would win. So I would be prepared to kind of fill in the blanks on a table like this for daily settlement, because the module goes through an example like this. We've done an example like this, and there are good practice problems. So this sounds like a really, really cool example, and you should be able to work through it. Remember, pay close attention to the initial margin and then the maintenance margin, because it doesn't make any sense for the Institute to give you a question where you hover around the initial margin. It's got to fall below the maintenance margin, so you have to put something in. So the likely question here on this table would be, hey, what happens on day T87? What's the variation margin? That sounds to me like the most likely question. And then you would just put 32,000. Now, let me go ahead and warn you here. Here, watch this. Swaps, swaps, and then that's it. All right, so what did we just do? We did forward contracts and futures contracts. And by the way, we have lots and lots of really cool discussions remaining in these following modules, but we still do a lot of cool stuff in mostly in level 2. Now, swap contracts, you might remember from Module 1, I told you was really just two entities looking at each other and saying, the grass is greener on the other side. I want what you have, and you want what I have, so let's go ahead and swap. Now, what we're not going to do is we're not going to swap the underlying asset. Like if I own a bond and you own a share of stock, we're not going to swap ownership. But what we might do is we might swap payments. We might swap cash flows. So if I own the bond, and let's just suppose it's a floating rate bond, I may agree to pay you my floating coupon rates, and you own a share of stock, which has a floating dividend payment. You may agree to pay me those floating dividend payments, right? So here's an example where we're going to exchange the cash flows that are based on an underlying asset. So you see how cool swaps are. It's not really just the underlying asset. We're not swapping that. We're swapping the cash flows. So look at that second diamond point. Exchange a series of cash flows whereby one party pays a floating rate and the other party pays either a floating rate in my example or a fixed rate. Most common swap contracts are exactly what the green and the blue say, right? Here we go. We're the green first. We're a fixed rate payer, so we're going to pay a fixed rate over here. And on the other side, it's the floating rate payer, so that entity is going to pay a floating rate. So notice the green arrow is fixed. That's 4.6 in this example. The blue arrow is dotted because that's going to change every year. And that's the secured overnight financing rate plus 1.5%. And that plus 1.5% probably has a lot to do with the default risk associated with either the two parties or the underlying asset or some kind of default risk in there. Now, here's the cool thing about a swap contract. I said this to you back in Module 1 that swap contracts are typically 3 or 5 years. They can be longer. I mean, there's no reason that we couldn't enter into or create a 100-year swap, but I'm not sure how many people would be interested in that. So the tenor of a swap, let's say is 5 years. And so notice we're going to swap a fixed for a floating. Maybe these are two different kinds of bonds. And so, boy, that's an awful lot like a forward contract or even a standardized forward contract, a series of forward contracts. Similar features with forwards, right? Notice the bottom second diamond point. A floating rate payer pays a market reference rate, an MRR, which in our blue example up there was the SOFR, the secured overnight financing rate. You might be aware that the LIBOR market reference rate is on its way out, if not completely out, because of some scandals over the last 5 years or so. Now notice the bottom, I did mention this in Module 1, there is a notional principal or a notional reference rate that we have to agree on. And that's really just a reference rate so that we can multiply the 4.6 by and the SOFR plus 1.5. So a notional amount could be $1 million, it could be $10 million, it could be $100 million, it could be $10 trillion. Let's take a look at a simple example of a swap contract where we're Findlay. We're going to enter a 10-year interest rate swap for a notional amount of 100 million US dollars. So what we're going to do is we're agreeing to receive a fixed rate of 5%, and we're going to pay the market reference rate. So what are we doing? We're receiving fixed and we're paying floating. All right, so for that first, now remember, when we enter the contract, we don't really know what that market reference rate is going to be. So after some time goes by, that market reference rate is 2%. So let's go ahead and calculate the first swap cash flow. All right, we're receiving that fixed rate. So let's take that 5% times the 100 million notional amount. And don't forget to divide that by 2, because remember, with the swap contract, we're going to do this semi-annual. So notice that first orange point. What are we agreeing to do? We are agreeing to receive 2.5 million in a fixed payment. Well, we have to turn around and make that floating rate payment. So what are we going to do? We'll take that 2%, cut that in half as well, multiply that by 100 million. So that gives us 1% of 100 million. That's $1 million. So what are we doing? We're receiving 2.5 million. We're paying 1 million. So what did we do? We won $1.5 million. So think about this, that what did we do? We are agreeing to receive the fixed and pay the floating. So when do we benefit? We benefit when rates fall, right? So this is an example of rates fall and we win. We won $1.5 million. And that was the short section on swap contracts. So let's go ahead to a longer section on options, and then we'll get into some other derivatives as we move along. So this is all part of that category of a contingent claim. And remember, back in Module 1, I was telling you that the very cool thing about an option contract is that it gives you the right to do nothing. So notice what the definition tells us. It gives the option buyer the right, but not the obligation. Back with swap contracts and futures contracts and forward contracts, you are obligated to either pay or receive. You are obligated, legally obligated. But here you're not, right? So you either have the right but not the obligation to buy an asset, that's known as a call option, or to sell an asset, that's known as a put option, at a fixed price. And that fixed price is known as the exercise price. When I was in graduate school, my professors always used the term exercise price. So that's what I tend to use, but most professionals use the term strike price. So either way. Now, two different kinds of options. European options can only be exercised on the expiration date. American style options can be exercisable the second after you buy the option. Lots and lots of examples on options. There are options on shares of stock. There are options on commodities. There are options on indexes. There are options on currencies. Here's a cool one. There are even options on futures contracts. There are even options on swap contracts. Now, remember what I was saying is that with this right but not the obligation, you can do nothing. Well, because of that nature and a couple of other natures of options is that these things are not free. Remember when I gave you that example of the futures contract that both the long and short position put up their own capital as a margin account. Remember, I kind of called that like an escrow account. Well, not so with options. You have to pay for options. And so the price of an option is also known as the option premium. So the buyer pays the writer or the seller of the option a premium. And depending on the conditions of the market and the conditions of the option, these premiums can be quite high. And the reason that they're quite high is because the seller of the option knows that we are very lazy and that we want to do nothing at some point in our life. So they're going to make us pay for the right, but not the obligation. All right, here's some notation that you will become super familiar with before you go ahead and take the level 1 exam. And by the end of level 3, you'll know all of this stuff here. So let's go ahead and try to figure this out. What is the profit from an option strategy? All right, so let's go ahead and take a look at a call option. So notice we have payoff, profile, call option. So what are we doing here? We have the right, but not the obligation, to buy a share of stock at a fixed price over a certain time period. And let's forget about that time period really now, because it doesn't matter whether it's a week or a month or a year. But what matters is the exercise price. So there's the notation in the middle. There's the uppercase X. That's always going to be the exercise price. So let's go ahead and take just a quick example here. Let's suppose that stock price is trading at 100. Exercise price is also $100. This is known as an at-the-money option. And so you buy this option from me. You're the buyer of the option. You're the owner of the option. I'm the seller. I'm the writer of the option. So what are you betting on? You're betting that the price of this underlying stock goes up, right? So the profit from a call option strategy has to reflect that, right? So if the price goes up, you have the right to buy from me for 100. Let's suppose it goes up to 150. Oh my gosh, this is just like our forward and our futures contract. You're going to run to my door and you're going to say, hey Jim, sell me that share of stock for $100 because I can immediately go to the New York Stock Exchange and sell it for 150. Now, remember what I said earlier, that most derivatives are cash settled. So what's most likely to happen is that I'm not going to sell you that share of stock because I probably don't own it. You're not going to buy that share of stock from me because you probably don't want to own it. You were just betting that the price went up. So I'm going to reach into my pocket and probably hand you $50. So that's the profit to the buyer. There it is, profit, the little pie sign. And so it's going to be the maximum of that stock price at the expiration date, time period T. What was that, 150 minus the $100 exercise price, and then minus the premium that you had to pay me. Now, of course, if the price falls like to $70 or $80, then you're going to allow the option to expire. So you lose everything that you invested. So that's a minus 100% loss. And then, of course, my profit is just the opposite. That's why we put a negative sign around those parentheses. So what are you hoping? You as the option buyer, you're hoping that the option finishes in the money, right? 150 is greater than 100. I hope the option finishes out of the money, and I hope the option also finishes at the money, because if it finishes at the money or out of the money, I get to keep the premium you paid me. Now, the payoff profile for a put option is exactly the same as it was for a call option, with the exception is that we now have to stand on our head. It's going to be just the opposite, because what we're doing now when we buy a put option is that we're going to benefit when prices fall. So you play the role of buying the put option from me. I'll be the role of the seller or the writer of the option. So let's go back to my example. Stock price is 100. Exercise price is 100. So you have the right, but not the obligation, to sell to me for $100. So if the price falls to $50, you're delighted about this, because what you can do is you can simply go buy the share of stock for $50 and then come to me and force me to buy it from you for $100. There's that $50 profit. Now, notice you don't have the share of stock when you buy the put option. I don't really want to have this share of stock. So I'm going to reach into my pocket and I'm going to go ahead and just hand you that $50, right? Almost all derivative contracts are cash settled. So notice the payoffs there to the buyer and the seller are just the exact opposite. Let me go back here, right? They're just the exact opposite. Instead of stock price minus exercise price for the call, it's now exercise price minus the stock price for the put. And then the profit, we subtract out the option premium as well. So here's an example of in and out and at the money, and it's just the opposite of a call option. All right, moving on to credit derivatives, and these things are really, really cool. The reading in this module emphasizes these credit default swaps. And so let me go ahead and tell you about these. These are so cool. Let's suppose that you're a bondholder and you have bought my bond, Jim's Concrete Company. And I've made you a promise to pay you, let's say $100 every year in coupon payments. And then in 5 years, the bond matures. So I've promised to pay you $1,000, right? So you start thinking about this default risk. You start wondering if I'm making enough money to pay that $1,000 to you on the maturity date of the bond. So what you do is you pick up the phone and you call a financial institution and you say to that financial institution, you say, hey, have you heard of Jim's Concrete Company? I don't think it's going to do very well. I like the bond, I like the coupon payments, but I'm worried about receiving that $1,000. So you ask the financial institution, you say, hey, look, if Jim defaults on his bond issue, will you pay me that $1,000? And of course, the financial institution, they don't ever turn anybody away. They always say, yes, of course, we'll pay you that $1,000 if Jim defaults, comma, if you make regular payments to us. So what you're going to do is you're going to buy this credit derivative. This is called a credit default swap. And if I default, what you're going to do is you're going to go to that financial institution and say, hey, Jim defaulted, pay me my $1,000. But this is after 5 years. So what you're going to do in the meantime is every year you're going to send them an annual payment. Now, if I'm Jim's Concrete Company and I have a CCC rating and nobody likes my concrete because it has rocks in it and it has mud in it, and so sooner or later it's going to catch up to me. Well, then this financial institution, they're going to charge you a lot, right? They may say, all right, for $1,000, we're going to make you pay $300 a year. So you pay $300 and $300 and $300. You're almost guaranteeing that I'm going to default. And so as my credit rating improves, if I go from CCC to double to B and then to AAA, well, you might only have to pay $10 every 6 months or every year to the financial institution. What does this sound like? Please tell me you got this. Credit default swap is nothing more than you're insuring a financial security, and that financial security is a bond. All right, so let's go through some of these details here. So the credit spread on a cash bond is the difference between the bond's yield and a specified default-free bond. And if credit default swaps, they're an awful lot like interest rate swaps. Their tenors are usually 5 years. And so what you would probably do is pick a 5-year treasury note. That sounds reasonable. Involves a credit protection buyer, right? And a credit protection seller, right? Provides protection. This sounds an awful lot like insurance. Well, let me show you how clever we are in the financial services industry. We can't call it insurance because then there would be 50 states insurance agencies that would hover above this credit default swap market, ready to impose all sorts of rules and regulations. So we just call it a swap. All right, so this is the illustration at the buyer. So what are we doing? Notice the blue dotted payment there. It's a contingent payment after a credit event. If I default, Jim's Concrete Company defaults. What happens if I don't default? Well, it's the same thing as if you pay your automobile insurance every year and you never wreck, right? You never collect anything from the insurance company. Well, the same thing holds true here. So what you're going to do is you're going to make a regular payment. It's usually a fixed payment to the protection seller, and it's based on some kind of a credit spread. I'm guessing those of you who have access to the Bloomberg terminals, just go ahead, get your terminal out tomorrow if you don't know this, and just type in, CDS and, type in Ford Motor Company or Johnson & Johnson or whoever you want, and you'll see the value of these. These are always reported in basis points. Now, one of the things that we need to worry about is if I'm Jim's Concrete Company, what a judge is going to do is a judge is going to say, okay, Jim has defaulted, so you can sue me, you as the owner of the bond, And I have all these assets. I have all these cement trucks, and I have cement things, whatever. I don't know anything about cement, so I'm making it up. I probably have rocks. I probably have sand. I have a whole bunch of stuff. So the judge is going to come in and make me sell that. So if I sell it and I get $300, well, then the financial institution is not going to pay you $1,000 because I've already paid you $300. They're only going to pay you $700. So determinants of the credit spread, that's the probability of default and then the loss given default. And so that loss, if I pay you the $300, you would get the $700 from the other financial institution. Let's go ahead and continue our discussion on option contracts. And what we're going to do in the next couple of slides is take a look at some graphs, and this will be really, really cool. So let's start off with just a quick review of this payoff profile from a call option. This is what we had before. Notice down at the bottom, all we're going to do is take the stock price minus the exercise price and then subtract out the call premium. And then, of course, we need to worry about whether the option is in the money or out of the money. So that's why we do the maximum of 0 or the stock price minus the exercise price. So keep those things in mind. Let's go ahead and look at a picture of a call option. So notice on the top right, what's the worst thing that can happen if we buy a call option? Well, we're long in the underlying asset, so the worst thing that can happen is if the stock price or the underlying asset price falls. So notice that's what we have in red. So notice that that's parallel to the horizontal axis because the most you can lose is the premium. So that's that first embedded bullet point. Maximum loss is the option premium. But what do we know about stock prices? We know they could go up to 100 or 200 or 5,000 or 10,000. I guess they could go up to infinity. I've never seen that before. But notice the second embedded bullet point, the profit for the buyer is unlimited. So that goes way, way up. I'm guessing if the institute says profit is infinite, you probably don't want to put that answer down unless the underlying stock price is infinity. The maximum loss for the short position then is unlimited. So there's the graph underneath, right? So if you write the call option, if you sell the call option and the price goes up, that means that you can lose an infinite amount of money or an unlimited amount. Now, when I write the option, what am I hoping? So let's go back to my example where we had $100 stock price, $100 exercise price, and let's just suppose that the call premium was $5. So you hand me $5. What I hope is I never see you again. And I'll never see you again as when the price falls, even just a little bit or a lot, and then I get to keep your premium. Now for me, that's a positive return. For you, that's a minus 100% loss. So the question then becomes, what is the break-even point? And this is always a great exam question. I do this for my students all the time. I draw these graphs regularly. In fact, just in my investments class the other day, we were doing an option straddle and strangle, which we'll do at some other later date. And I was telling them about the break-even point, and I was asking them, okay, I say, look, if my lectures make any sense, tell me what these break-even points are. And I had a handful of students who did this right. So notice that second to last bullet point there. Break-even point for both long and short position is just the exercise price plus the premium, and that should make sense. And once again, zero-sum game. So let's do a couple of quick examples here. Let's see, call premium of $2, exercise price of $30. Consider the price of the underlying asset at $25, $30, or $40. Now remember, when you pay me, and I'll just assume that you're playing the role of the option owner and I'm playing the role of the option writer, you pay me that $2 today. We have no idea what that price is going to be when the option expires. But in order to set this in an academic environment, when I create exams, and the institute is going to have to say something like, suppose the price at expiration is, and that's what the 25, 30, and 40 is. Those are potential future stock prices. So find value and profit at loss. So let's go ahead and start at $25. So what do you have? You have the right, but not the obligation, to buy at $30 from me, right? So the question is, why would you pay me $30 when you can go to the New York Stock Exchange and buy it for $25? So what you do is you allow the option to expire. So the value at expiration is 0. So that's what we're talking about back here, right? Maximum of 0, or stock price minus the exercise price. And then let's go ahead and, so the value is 0, but you paid me $2, so you lost $2, right? So you lost $2. That's a minus 100% for you. And I gained $2. I got to keep your option. How about at 30? Well, this doesn't really help you at all because this is an at the money option. So you're not going to exercise your option and pay me 30 when you can go to the New York Stock Exchange and pay 30. So the value is 0, right? And so you still lost $2. I get to keep your $2. You still lost 100%. Now, $40, this is where you bet on, right? You bet that the underlying asset price was going to go up. So at expiration, you just take the difference between the stock price at expiration, 40, minus the exercise price of 30. So that's $10, right? So you had a value. So I reach into my pocket and I hand you $10. But you had handed me $2 months ago. So your profit is 10 minus 2, $8. And I lost $8. Once again, this is a zero-sum game. All right, here's a slide that we did, 10 or 12 slides ago. This is the payoff and the profit from buying a put option. So here are the pictures of put options. And, what did I say to you earlier? That here was the call option, and then we got to kind of turn our heads upside down to get to the put option. And so these graphs are pretty much just kind of reciprocals or inverses or upside down looking. So let's take a look at the top right illustration. So once again, you bought the put option from me. So you're the top graph. I'm the bottom graph. So when do you win? Well, you win when prices fall, right? You bet that the price is going to fall. So there's that green arrow. So that goes up, and that's going to hit the horizontal axis too, by the way, at some point up there, probably at the exercise price. But then what happens here? When do you lose? You lose if the price goes up. So in the red, the most you can lose is the option premium. Now, what about me? I'm going to win if the price goes up. There's that green going that way along the horizontal axis, and then there's the red that goes down there, and it probably hits the vertical axis somewhere along there. Notice the bottom one, zero-sum game. So let's go ahead and work through just a quick example here. Let's see, strike price of 30. Put premium of 2, consider the price of the underlying at 20, 30, and 40. All right, so at $20, this is good news for you, right? You bought the put option. You have the right but not the obligation to sell at 30 when the price is only $20. So at expiration, you're going to knock on my door. I'm going to hand my $10 over to you. So the value of the option is $10, but remember, you paid me $2 several months ago. So your put option profit is 10 minus 2 is $8, which means I lost $8. How about at 30? Well, this is same thing with the call option. This is an at the money put option. And so this does you no good. It does me a lot of good because I get to keep your $2. So the value is 0 at expiration, and you lost $2 and I gained $2. Now, when the price goes up to 40, this still isn't doing you any good. Remember, you bet that the prices fall, so the value is still 0. You lost $2, and I got to keep your $2. So I want you to think about this from the short position, my position, as the writer of the option. When we show up on the floor of an exchange or in an over-the-counter market, wherever this is, and you hand me a premium, whether it's for a call option or a put option, you hand me $2 or $10 or $20, whatever it is. What am I betting on? I'm betting that I never have to see you again. And that will occur with a call option if the price falls, and with the put option if the price rises. Now here's that last one that we did back in Module 1, forward commitments and contingent claims. So this is pretty much just a review. Remember, these forward commitments, this is an obligation. Both parties are obligated to trade at some time in the future, and they agree to a price today. Contingent claims, on the other hand, there's probably something that changes hands either today, like with a call or a put option, or over time, like with a credit default swap. And that contingent claim depends on some kind of an outcome occurring. So that takes us through Module 2. Go ahead and look at this module, look at the end. Once again, I'm just disappointed there's just a short paragraph and then 4 questions that address all of these. So we did way much more than just 4 questions. So I encourage you to take a look at all of our practice questions. Hey, thanks for watching and good luck studying.